Stop scrolling. Stop checking your portfolio balance for the 15th time today. Stop refreshing the silver price ticker like it's going to show you something different in the next 30 seconds. Because what happened in the silver market over the last 4 hours is not a normal correction. This is not profit taking. This is not a technical pullback that some analyst in a tie with a whiteboard warned you about last week. This is an attack, a coordinated, calculated, mechanical destruction of the most explosive rally in silver's modern history. And before we go any further, this is Chill Guy. If you want real breakdowns like this that the mainstream won't touch, hit subscribe right now, smash like and drop a comment so I know you're locked in. And if you're sitting there thinking, this was just market forces at work, just supply and demand finding equilibrium, I need you to understand something right now. Markets don't move like this naturally. Markets don't erase 7 talons per ounce in 4 hours without someone pulling the kill switch. Today is Tuesday, January 27th, 2026, and this morning silver touched $117.73 per ounce. That is the highest price silver has ever traded in human history. It shattered the previous record. It broke through psychological barriers that analysts said would take years to reach. The bulls were celebrating. The stackers were vindicated. The people who have been screaming about silver for decades finally had their moment. And then, in less than 4 hours, it was gone. By early afternoon, silver had cratered to 1.389, a drop of 6.55% in a single session. Nearly $14 per ounce vaporized for those holding leveraged positions, for those who bought at the top thinking this was the breakout. This wasn't just painful. This was annihilation. But here's what you need to understand. This crash didn't happen because silver suddenly became less valuable. It didn't happen because industrial demand evaporated overnight. It didn't happen because investors woke up and decided precious metals were a bad idea. This crash happened because someone decided it needed to happen. And when I say someone, I'm not talking about a Reddit forum or a group of retail traders panic selling. I'm talking about the institutions that control the levers of the paper market. I'm talking about the exchange that sets the rules. I'm talking about the banks that have been on the wrong side of this trade for years. They pulled the trigger. And today, we're going to show you exactly how they did it, why they did it, and most importantly, what this means for everyone holding physical silver right now. If you're here because you want the truth, if you want to understand what just happened beyond the headline noise, hit subscribe right now. Drop a comment, even just RJ Chill Guy, so the algorithm knows you're actually paying attention. Because what we're about to walk through is the kind of analysis the mainstream financial media will never give you. They'll tell you it's volatility, they'll tell you it's a bubble popping, they'll tell you to move along, nothing to see here. But we're going to show you the trade sheet, we're going to show you the margin hike, we're going to show you the banks involved, and we're going to explain why this moment, as brutal as it feels, might actually be the last desperate move before the entire paper pricing system collapses for good. Let's start with the weapon. Because to understand how they killed the rally, you need to understand the one tool the exchange has that can stop any market cold. It's called a margin hike. And on the surface, it sounds boring. It sounds like technical jargon that only affects professional traders. But in reality, a margin hike is a financial weapon of mass destruction when deployed at exactly the right moment. Here's how it works in plain English. When you trade silver futures on the COMEX, which is the major exchange for paper in the United States, you don't have to pay the full value of the contract up front. You only have to put down a fraction of the total value as collateral. That's called margin. Think of it like a deposit. If you want to control one contract, which represents 5,000 ounces of silver, you don't need $500,000. You might only need $22,000 in margin. This leverage allows traders to amplify their positions. It allows them to bet big without having massive amounts of capital. It's what makes the futures market liquid and active. But here's the catch. The exchange, in this case the CME group, has the power to change those margin requirements whenever they want. And when they raise the margin requirement, they force every single trader holding a position to either deposit more cash immediately or close their position. And that's exactly what they did. On January 7th, 2026, the CME group announced a massive 47% increase in silver futures margin requirements. They raised the maintenance margin from $22,000 per contract to $3,500. That's an additional $2,500 per contract that every trader had to come up with immediately or face force liquidation. Now, let me put that in perspective. If you're a hedge fund or a large speculator holding 100 contracts, that's an additional $1 million and $50,000 you have to wire to the exchange right now. If you're a retail trader who scraped together the capital to hold 10 contracts, that's an extra $15,000 you probably don't have sitting in your account. So what happens? You sell. You're forced to sell. Not because you think silver is going down, not because your thesis changed, but because the exchange changed the rules in the middle of the game, and you do not have the liquidity to keep playing. This is the kill switch. This is how you crush a rally without firing a single bullet. You simply make it too expensive for anyone to hold their position. And the timing of this move is not accidental. Silver had just broken through $110. Momentum was building. Shorts were getting squeezed. The physical market was screaming that supply was running out. Lease rates, which measure how expensive it is to borrow silver, had spiked to 8%. For context, normal lease rates are around 0.3 to 0.5%. When lease rates hit 8%, it means the market is desperately short of physical metal. So the exchange saw the freight train coming. They saw that if silver kept climbing, if it broke through $120, $130, $150, the entire paper market could implode. Banks that are short silver would face catastrophic losses. The system that allows them to control the price with paper contracts would break down. So they pulled the kill switch, they raised margins, they forced liquidation, and they turned a historic rally into a flash crash. But here's the part that should make your blood boil. This is not the first time they've done this. This is a pattern. This is a playbook they've run before. And when you look at the history, the evidence of manipulation is undeniable. In 1980, when silver surged toward $50 per ounce, COMEX stepped in and restricted new long positions. They changed the rules. They killed the rally. The Hunt brothers, who were accumulating massive amounts of silver, were wiped out and silver collapsed. In 2011, when silver hit $49 and was threatening to break the all-time high, the CME raised margins 5 times in 8 days. 5 times. They crushed the rally. Silver fell from $49 to $26 in a matter of weeks. And now in 2026, history is repeating. Silver breaks records. The exchange raises margins and the rally dies. This is not a free market. This is a controlled market. And the controllers are the same institutions that have been fined, investigated, and exposed for manipulation over and over again. Let me give you a name: JP Morgan. In 2020, JP Morgan paid a record $920 million fine for manipulating precious metals markets. That's not a conspiracy theory. That's a settled legal case. They admitted to spoofing, a practice where traders place fake orders to manipulate prices. They admitted to rigging the market for years. And today, JP Morgan is one of the largest players in the silver market. They are one of the primary dealers on the COMEX. They are sitting on one of the largest physical stockpiles of silver in the world. And they have been on both sides of this game shorting paper while accumulating physical. So when you see a margin hike that perfectly coincides with a historic price spike, and when you see the same bank that was fined for manipulation heavily involved in the delivery process, you have to ask yourself, is this really just about managing volatility, or is this about protecting the banks that are short? The answer is obvious. This was an attack. This was a coordinated effort to stop silver from breaking free of the paper pricing system, and they succeeded for now. But here's what they can't control. They can manipulate the paper price. They can force liquidation in the futures market. They can crash the chart. But they cannot create physical silver. They cannot mine it out of thin air. They cannot refine it with a keystroke. And that's where the real story begins. While the paper price was getting murdered in New York, something completely different was happening in the physical market. And this divergence, this growing gap between what the screen says and what people are actually paying for real metal, is the most important story in the silver market right now. Let me give you a number that should shock you. While COMEX was trading silver at $111 after the crash, physical silver in certain parts of the world was changing hands at $130 per ounce. In Japan, reports indicate physical silver clearing at $130. In Kuwait, $16. In South Korea, $97. Even in the United States, premiums on physical coins and bars have exploded. The spread between the futures price and what you actually have to pay a dealer to get metal in your hand has widened to levels we've never seen before. This is what we call the Great Divorce. The paper market and the physical market are no longer speaking to each other. They're operating in 2 different realities. And the reason for this split is simple. There's not enough physical silver to meet demand at these paper prices. Let's talk about supply for a moment, because this is where the manipulation breaks down. The paper market can print infinite contracts. They can create synthetic ounces with a computer. But the physical market cannot. Physical silver has to be mined, refined, fabricated, and delivered. And every step in that process takes time, energy, and real resources. Right now, the physical market is screaming shortage. COMEX registered inventories, which is the silver available for immediate delivery, have plummeted by over 70% since 2020. That means the amount of silver sitting in vaults ready to be delivered to contract holders has collapsed. We're talking about a drop from hundreds of millions of ounces to a fraction of that. And it's not just the United States. In London, which is the other major hub for silver trading, inventories have been draining at an alarming rate. Between early January and mid-January 2026, 33.45 million ounces were physically withdrawn for delivery from COMEX. That's 26% of registered inventory in a single week. When you see that kind of drain, when you see physical metal leaving the system at that pace, it's a sign that people no longer trust paper promises. They want the real thing. And when everyone wants the real thing at the same time, the price should skyrocket. But the paper market keeps it suppressed with margin hikes and forced liquidation. Now, here's where it gets even more interesting. On January 1st, 2026, China implemented one of the most aggressive export control regimes in modern commodity history. China reclassified silver as a strategic dual-use metal. That means they now treat silver the same way they treat rare earth elements and critical defense materials. You can no longer export silver from China without government approval. And only 44 companies have been granted licenses to export silver over the next 2 years. Why does this matter? Because China processes and refineses more than half of the world's silver supply. They are the middleman between the mines in South America and the factories in the West. When China chokes off exports, they choke off global supply. And that's exactly what's happening. The immediate effect of this policy has been a spike in premiums in Asia. In Shanghai, physical silver premiums over the London spot price have reached $8 per ounce. That's the widest spread on record. Chinese buyers are panic buying physical metal because they know that once the export restrictions fully kick in, silver is going to become even harder to get. And here's the geopolitical angle. This isn't just about supply and demand. This is about weaponizing commodities. Silver is embedded in every piece of modern technology. It's in solar panels, it's in electric vehicle batteries, it's in semiconductors, it's in military electronics. When China controls the flow of silver, they control the flow of technology. They control the supply chains of the West. So while the paper price is getting smashed on COMEX, the physical reality is this. Silver is becoming a strategic asset. Governments are realizing that without silver, you can't build the green energy infrastructure. You can't manufacture high-performance electronics. You can't compete in the AI revolution that requires massive data centers full of silver-laden components. And that brings us to the most critical question. If the physical market is so tight, if demand is so strong, if governments are hoarding and restricting exports, why isn't the price reflecting that reality? The answer is that the paper market is still in control. But that control is slipping. Every margin hike, every forced liquidation, every attempt to crush the rally is a sign of desperation because the more they manipulate the paper price, the more people realize the paper price is a lie. And when enough people realize the lie, they stop trading paper and they start buying physical. That's when the system breaks. That's when the COMEX is forced to declare a cash settlement because they don't have the metal to deliver. That's when the paper price becomes irrelevant and the physical price becomes the only price that matters. We're not there yet, but we're getting close. And the attack we saw today is proof that the people running the system know it. Let's talk about the casualties. Because when you raise margins by 47% overnight, when you crash the price by $14 in 4 hours, someone has to lose, someone has to pay. And in this case, the losers were the traders who believed the rally was real and who bet accordingly. The most dramatic example comes from India. In the city of Rago, which is a major hub for silver trading in India, 44 silver trading firms officially declared insolvency in the wake of the margin hikes and price crash. These firms had combined liabilities of $425 million. That's not a typo. $425 million in losses from a single coordinated attack on the silver market. These were not small-time speculators. These were established trading houses that had been operating for years. But they made the fatal mistake of holding paper positions, not physical metal. They were playing the futures game. They were leveraged. And when the CME pulled the kill switch, they couldn't meet the margin calls. They were liquidated. Their businesses were destroyed. And here's the cruel irony. While these Indian firms were going bankrupt, the price of physical silver in India was soaring. On the multi-commodity exchange in India, silver hit a lifetime high of 2,50,692 rupees per kilogram on January 7th. That's roughly 113 per ounce after conversion. So physical silver in India was trading higher than the COMEX paper price. The physical market was screaming by. But the paper traders who were leveraged on margin were getting annihilated because the exchange changed the rules. They had the right thesis. They just had the wrong instrument. This bankruptcy wave in India is a microcosm of what's happening globally around the world. Traders who are exposed to paper silver, who are playing the leverage game, are getting crushed. Not because they're wrong about silver, but because the system is designed to crush them when they threaten the status quo. And it's not just retail traders. Even large institutions are feeling the pain. Banks that are short silver have been hemorrhaging money as the price climbed throughout 2025. According to the Commodity Futures Trading Commission's Commitment of Traders report, as of early December 2025, commercial banks were net short 212 million ounces of silver. 212 million ounces. At $100 per ounce, that's a 21 billion short position. Every dollar that silver rises costs these banks $212 million in paper losses. When silver went from $80 to $17, that's a $37 million move. That's $7.8 billion in losses for the shorts. So, who do you think has an incentive to crash the price? Who do you think benefits when the exchange raises margins and forces liquidation? The answer is the banks that are short. The answer is the institutions that control the COMEX. The answer is the same players who have been fined for manipulation before. This is why the attack happened. Not because silver fundamentally deserved to crash, but because the shorts needed relief. They needed to buy back their positions at lower prices. They needed to reset the board before the losses became existential. But here's what they didn't account for. Every time they manipulate the price lower, they create buying opportunities for physical buyers. Every time they crash the paper market, they widen the gap between paper and physical. And every time that gap widens, more people lose faith in the paper system. This is a war of attrition, and the shorts are losing. Yes, they can win battles. They can crash the price for a few hours or a few days, but they can't win the war because they can't create physical supply. And at the end of the day, physical silver is what matters. For those of you watching who are holding physical metal, this is the moment where you need to understand your position. You're not holding a paper promise. You're not exposed to margin calls. You're not at risk of forced liquidation. You are holding a real asset that cannot be printed, cannot be rehypothecated, and cannot be seized by an exchange rule change. The people who got wiped out in this attack were the ones playing the paper game. The people who survive are the ones holding the metal. And when the dust settles, when the paper market finally breaks, the physical holders are the ones who will have wealth. The paper holders will have nothing but a cash settlement from a bankrupt exchange. So, where do we go from here? What happens next? Because if you're sitting there holding silver or if you're thinking about buying, you need to understand what the endgame looks like. You need to understand what happens when the paper pricing system finally collapses under its own weight. There are 3 possible scenarios. Let's walk through each one. Scenario 1, the system resets higher. In this scenario, the paper market admits defeat, the COMEX. Seeing that physical demand is overwhelming and that inventories are drained allows the price to rise to a level that actually reflects physical reality. That means we could see silver move to $150, $200, or even higher as the paper shorts are forced to cover and the physical premium collapses back to normal levels. This is the bullish case. This is the scenario where silver holders win big. But for this to happen, the exchange and the banks have to stop fighting the market. They have to accept that silver is repricing. And based on today's attack, they're not ready to do that yet. Scenario 2, the divorce becomes permanent. In this scenario, the paper price and the physical price never converge. Instead, we end up with 2 separate markets. The COMEX continues to trade paper contracts at suppressed prices, but nobody cares because the physical market has moved on. Physical silver trades in a parallel market at much higher prices, and the paper market becomes irrelevant. This is actually the most likely scenario in my opinion because once trust is lost, it's almost impossible to get it back. And right now, trust in the paper market is evaporating. When physical buyers in Asia are paying $30 to $40 more than the COMEX price, that tells you the paper price has already lost its authority. In this scenario, physical holders win because they have the real asset. Paper holders lose because their contracts get settled in cash at the suppressed paper price, and they miss out on the physical premium. Scenario 3, force majeure and system collapse. This is the nightmare scenario for the paper market. In this case, demand for physical delivery overwhelms the available supply in the vaults. The COMEX is forced to declare force majeure, which means they cannot fulfill their delivery obligations. Contracts that are supposed to result in physical silver are settled in cash instead. And when this happens, the entire pricing mechanism breaks down. Because if the exchange that's supposed to set the price can't actually deliver the metal, what credibility does that price have? None. In this scenario, the paper price crashes because nobody trusts it anymore. But the physical price explodes because the only way to get silver is through the physical market, and supply is finite. This has almost happened before. In March 2020, during the COVID panic, the gold futures market nearly broke because physical delivery became impossible due to logistics. The premium on physical gold coins spiked to $50 or more over the spot price. The system came within days of a force majeure declaration. They avoided it by emergency measures, but it was close. If silver goes down that path, if the COMEX has to declare force majeure, it will mark the end of paper-based price discovery for precious metals. And the new price, the real price, will be set by physical buyers and sellers in a decentralized market. Now, let me connect this to what we're seeing today. The attack on silver, the margin hike, the forced liquidation, these are all signs that we're moving toward one of these scenarios. The paper market is fighting for survival. They're using every tool they have to maintain control, but every time they pull the kill switch, they weaken their own credibility. Think about it. If you're a physical silver buyer in China or India and you see the comps crash the price by $14 in 4 hours through a margin hike, does that make you trust the COMEX price? No. It makes you realize the COMEX price is a manipulated fiction. It makes you focus on the physical market and ignore the paper noise. And that's exactly what's happening. Physical buyers around the world are decoupling from the COMEX. They're building their own pricing networks based on actual supply and demand in their regions. And as more of the world does this, the COMEX becomes less and less relevant. For those of you holding physical silver, this is why you hold. Not because the paper price is going up in a straight line, but because the paper market is dying. And when it dies, the physical market is all that's left. And in that world, you have wealth. Real, tangible, unmanipulable wealth. Let's bring this home. Let's talk about what you should actually do with this information. Because understanding what happened is only valuable if it changes your actions. First, if you're holding physical silver, do not panic. Do not let today's price action shake you out. Remember what you saw today was a paper market attack. It was not a fundamental change in silver's value. The physical market is still tight. Industrial demand is still strong. China's is still restricting exports. The supply deficit is still real. What happened today is noise. It's manipulation. And if you sell your physical silver because of a margin hike on the COMEX, you're letting the manipulators win. You're giving them exactly what they want. They want you scared. They want you to sell. Don't. Second, if you're thinking about buying, understand that pullbacks like this are opportunities. When the paper price crashes due to forced liquidation and the physical market hasn't moved much, that's when the gap between paper and physical is at its widest. That's when you can buy physical at a discount to what it's actually worth. And this is critical. You have to buy physical, not paper, not ETFs, not unallocated pool accounts, not futures contracts, physical metal in your possession. Because if you buy paper, you're exposing yourself to the same risk that just wiped out 44 firms in India. You're putting your trust in a system that has been proven over and over again to be rigged against you. Third, manage your expectations on timing. The endgame I described, whether it's a price reset, a permanent divorce, or forced major collapse, could happen in months or it could take years. Nobody knows. What we do know is that the structural fundamentals are in place for a massive repricing. But the timing depends on how long the paper market can hold on. The shorts are desperate. The exchanges are intervening. The banks are manipulating. They're fighting with everything they have. But they're fighting against physics. They're fighting against geology. They're fighting against the fact that you can't print silver. And in that fight, the physical holders have the advantage because time is on your side. Every month that goes by, more silver gets consumed in industry. More inventories get drained. More people realize the paper price is fake. And eventually the dam breaks. Fourth, diversify your understanding. Don't just listen to one source. Don't just watch one channel. Do your own research. Look at the COMEX inventory data. Look at the lease rates. Look at the premiums in different countries. Look at the commitment of traders report. The data is public. The evidence of manipulation is there for anyone willing to look. And when you see the evidence yourself, when you understand the mechanics of how the system works, you become immune to fear. You become immune to price manipulation because you know what you're holding. You know why you're holding it, and you know the paper games can't change the physical reality. Fifth, engage with this content. If you found value in this breakdown, if you learned something, if you understand the silver market better now than you did 30 minutes ago, show it. Subscribe to the channel, hit the like button, share this video, comment below with your thoughts. Even just typing RJ Chill Guy helps the algorithm push this to more people who need to see it. Because the mainstream media is not going to tell you this story. They're going to say silver crashed because of profit taking. They're going to say it was overheated. They're going to ignore the margin hike. They're going to ignore the bank manipulation. They're going to ignore the physical shortage. We're here to tell you the truth. The truth is that silver was attacked today. It was attacked by the same institutions that have attacked it before. It was attacked because it was threatening to break free of their control. And it will be attacked again. But every attack makes the physical market stronger. Every attack wakes up more people. Every attack brings us closer to the day when the paper market finally breaks and the real price of silver is revealed. That day is coming. I don't know if it's next month or next year, but it's coming. And when it does, the people holding physical silver are going to be on the right side of history. So hold your mettle, ignore the noise, understand the game, and prepare for the end game. This is your moment. This is your advantage. The manipulators are showing their hand. They're showing you that they're desperate. They're showing you that they can't control the physical market. They can only control the paper illusion. And illusions don't last forever. Thank you for watching. Thank you for being here. And thank you for seeking the truth. Subscribe, share, and I'll see you in the next one. The attack happened. Now you know why. And now you know what to do. Rewrite, please.